So today what we're going to be doing is something that no educational company, from my understanding, has ever done before. We're going to be showing you our quarterly returns report, our quarterly investors report, but most importantly, we're going to be showing you exactly how we managed to make a higher return in one quarter than investment banks and hedge funds made for the whole of the last quarter. Stay tuned if you're interested in finding out how we did it. Okay, so like I said, we're going to be talking about quarterly returns. So just a simple introduction to where these returns are coming from. To any of you who do not know about who I am and what I do, I run MS Equities Trading. Part of what we do is we run an educational company that trains students all around the world, but also I run an investment group. So I spend my time trading in the financial markets on behalf of my clients' portfolios, and I am moving money in and out of the market throughout the month. This is why I also educate my students. I teach them what I do as well. And what we're going to be doing in this video is we're going to be showing you those returns over the last 3 months, and we're going to be explaining exactly how I managed to make more money than the hedge funds and investment banks managed to make in terms of percentage-based returns. So this video is going to be a lot of information, a lot of really new things, and lots of stuff that you're going to be able to learn from and also enjoy listening to. Firstly, I'd just like to make sure to any of you who are interested in learning more about trading, investing, and wealth management, make sure to subscribe to this channel because we have weekly educational videos coming out. Also make sure to have a look through that video library of ours. There is tons and tons of educational videos that I'm sure you'd be able to learn a lot from that is going to positively impact your trading and investment future. So going back to the video, what we're going to be doing is I'm going to be popping up slides of my quarterly investors report. I'll also make it available in the link down below for you to actually go and download. Also, it is up on my website for you to read, so you can have a look at these results. Just to start off with, these results are verified by a third party. So these results are also being verified by my FX book. Now, just a disclaimer, please, if you have a look at these returns, there are going to be slight variations between what is in our report and what is displayed on my FX book. That is just specifically because we use different accounting and auditing processes. So it's not like I'm trying to skew the results. In fact, in my investment reports, the returns that we're displaying are lower than the returns on my FX book. That's just specifically because their public verification site uses simple, different. That's just specifically because their verification site uses completely different calculation processes. But just to let you know, these results are real and verified, and it's not like I'm going to be showing you something fake. So effectively, like I said, I'm just going to be throwing up some slides and I'm not going to be reading through this report too much. I prefer for you to read through it yourself, but as I throw up these slides, you can just take some time to pause the video and read through each slide if you prefer. And at least then we can skip through this video as fast as we can so I can show you the secret sauce behind why I managed to make these returns. So basically the reason why our quarterly returns are not like the normal quarter of January, February, March, we started our investment group a month earlier than the quarter rollover. So our quarter that we're going to be displaying now is actually December, January, and February. Now to any of you who know what happened in the month of February, February was one of the toughest months in the financial markets in many years. The Dow Jones and the S&P 500 took one of its biggest drops in equity return since 2012. So the valuations dropped so fast, and it dropped in just a single week in the first week of February. Furthermore, hedge funds and quant funds also had one of their worst months and weeks in history. Quant funds lost close to 14% across multiple different funds around the world in the first week of February alone, just from that major market crash. And following that was the tail end of major volatility for the whole of February. So many big funds and investment groups took huge hits during this time. Now, the reason why you're going to find a lot of value in this report is because the month of February was the biggest month we ever had in our investment group. And it's specifically because we base our investment strategies on volatility. So we're going to explain to you exactly how we managed to produce that, but once again, we're going to be showing you the returns as well. As you can see on the first slide, all we're basically doing is giving you a simple introduction to the quarter that we've just produced. And as you can see, we talk about going forth that we've been able to produce a profitability ratio in the last quarter of an 89.55%. That effectively means 89.55% of the trades we executed were winning trades. More importantly, we managed to limit our average maximal drawdown to only 0.48%. So the biggest loss we took our entire portfolio was only 0.5%. Now, this is also a very, very important number to consider. During the months that were so volatile, we managed to keep our drawdown almost to the lowest that we've ever had. More importantly, what I talk about in that slide is about the consistency of our returns, the stability of our portfolio, and the fact that we were able to take advantage of volatility and that we didn't lose money during that period of time. Now, this is obviously something very important because we are in markets that are very, very volatile at this point in time. It's no longer risk on every single week where the market is just making higher highs all the time, like we saw in 2017. We're taking advantage of massive volatility, central banking policy change. We're also taking advantage of the fact that there's a lot of economic instability and political instability around the major markets of the world between Europe, Britain, and America. So those are also things that we need to consider, the fact that we are taking advantage of a time where it's much more difficult to make money, much more difficult than 2017. On the second slide that I've put up now, what you can see is basically a table, a graph, and a little bit of writing. These are going to be some important pieces that we're going to talk about. So for the quarterly return for the last 3 months, we managed to maintain 5.92% gain. You can also see that the maximal drawdown was 0.48, like I mentioned previously. The profitability was 89.55%, and the profit factor was 7 times our risk. What the profit factor effectively means is for every dollar that I'm losing, I'm making 7. So if the profit factor is 1 to 1, that effectively means that for every dollar I'm risking, I'm making $1. This metric means that we're now making 7 times what we're losing. So that effectively means that not only is our profitability ratio so high, our profit factor is also incredibly high as well. So in terms of our performance, we've been very, very happy to see that our risk ratios have decreased massively while our returns have continued to go up, which is actually interesting because people feel in order to create higher returns, your risk needs to go up at the same point in time. For us, we don't necessarily have to do that when we're trying to produce higher returns. As you can see, going back onto that slide, you can see the conservative fund monthly returns in December were 1.376%. In January, we managed to produce slightly higher at 1.58, but the absolute knockout month, like I said, in February, was a return of 2.95%. And as you can see on the right-hand side, there's something very important that I say there. As seen on the graph to the left, the monthly returns have averaged 1.97% return, and that is per month, which is not only exceeding the monthly target by 0.31%, the volatile month of February proved the resilience of my investment strategies. So what I'm effectively saying there is not only during the month of February did we manage to produce exceptional returns, over the 3 months we averaged above our monthly target. So we're very happy to be able to sit back and say that we produced above our monthly goal. And not only did we do that, we were able to take advantage of the fact that there were incredibly volatile times during February, but we were still making more money. That is also very important. Usually it's the complete opposite. When portfolios experience extreme volatility, you'll see a dip in their returns, a rise in their volatility and their risk ratios. Whereas for us, we saw the exact opposite. Going into the second slide, as you can see, we're looking at the equity return graph. So this is the bread and butter. This is the important part, seeing where our trades are actually moving. And as you can see, we had a very, very consistent upward trend in our returns. So as you can see, like I mentioned in that piece of writing just above, I talked about the high profit factor of 7 times our risk, and also talking about the profitability of 89.55%. So as you can see, because our drawdowns were also so incredibly low, we didn't have any massive dips into the losses on our portfolio. There were no curves going downwards, there was no damage to our portfolio or no major losses. It was just one singular rise in our returns that was very consistent. And that's specifically based against the system that we make use of and the investment processes that we use. Now, going into the detailed metrics, I'm not going to dive into this too much, but what I'm going to do is give you some time to read through it, but then also list up this table. So as you can see over there, I've listed up a table that shows you the specific aspects for December, January, and February. So just to run through it quickly, as you can see, I've listed the number of trades for each month, so you can see how many trades we executed for each month. I've listed the maximum drawdown, the win ratio, the profit factor, and the percentage gain. Most importantly, if you have a look at February, our maximum drawdown was only 0.14%. So effectively, that drawdown was so incredibly low, we didn't lose any money at all. Our win ratio was 96.43%. So our win ratio, out of 56 trades, we only lost 2 trades. That was very, very good for us to see. And then most importantly, we had a profit factor of 18.93. In the month of December, I actually referenced much lower down. I was saying, as seen in January and February, the maximum drawdowns had been greatly reduced from December. The 0.48% drawdown experienced in December was the result of hedging portfolio risk, which formed part of a systematic risk management strategy to protect the portfolio returns from any possible losses. Nevertheless, this drawdown was clearly planned and did not affect the overall return. So like I was mentioning, that there's that 0.48% drawdown in December was specifically based on a hedging strategy that I make use of. So I knew going into that position, I was going to make the loss. And I knew that the second I recovered that position, I was going to be in more profit. So let's say, for example, that position alone was a total gross gain of 0.68%, but we had that 0.48% drawdown. Minus the drawdown, we made a net profit of about 0.20%, which we were still happy to walk away with, given the fact that we could also cover our risk and our drawdown during those volatile times. This position was actually on a gold trade. Now, what I'd like for you to do is spend some time reading through that information, because I talk about the specific metrics behind the returns that you can see and the detailed metrics that you would be able to learn from and understand a lot more about. But going on to the next page is talking about our market outlook for the quarter going forward. And as you can see here, it's a lot of writing. What I'd like for you to do is take the time to go and read the reports on our website. I think it's actually going to be better for the website to be used. I'm going to put it up on the screen here. Make sure to go have a look at it, because what we've done is we've put 4 separate paragraphs speaking specifically about the trades that we're going to be moving into during the next quarter. And these are trades that you could probably take advantage of and make quite a lot of profit from. So please make sure to jump onto our website and read up on that if you're interested in finding new opportunities that you can make money from. But what I'm going to do is skip onto the last page so we can jump through this and get to the last point available. So as you can see on the last slide that I've just thrown up now, I'm talking about the third quarter goals going forward and then just closing off the newsletter. So the 4 goals that I've managed to write down, starting with number 1, is to maintain an average monthly return of 1.55% or greater. The second one is to produce a desired quarterly return of 4.6% or greater. So that's naturally how much we're trying to produce every single quarter. Maintain an average profitability ratio of 80%, as well as maintain a minimum profit factor of 6 or higher. Now, if you go back into our returns previously, that is obviously a big reason behind why we managed to produce such a good portfolio quarter. Those are obviously going to be the goals moving forward. And as you can see in that letter, I also talk about how the previous quarter's goals were perfectly achieved. Every single goal we put forward in our previous quarterly investors newsletter was achieved with extreme precision. And that's also important for us to consider, is that moving forward for the next quarter, if we want to replicate these results, what do you think we should do? The same thing we did this quarter, correct? Yes. So between second quarter and third quarter, we're not going to be changing much, because what we're doing is working. It's kind of like the policy of don't fix what isn't broken. And that's exactly what we're going to do. We're not going to fix anything because nothing is broken. And then just to end off with, in that letter, I basically closed off saying thank you to all the investors and the clients and the students that have become part of our investment group and academy over the last quarter. And also moving forward, we look forward to producing the same returns for you or even greater returns. Now, to go back into exactly how we were able to produce these returns, inside that newsletter, you're going to be able to learn a lot about how I managed to produce those returns. But most importantly, here's what it comes down to. It comes down to creating a process that works perfectly for you. It also comes down to understanding the strategies that you're able to use at the right point in time. So when the market is going west, you need to go west with it. If the market is going east, go east with the market. Don't go against the trend, go with the trend. We don't surf against waves, we surf with waves. Another point is also about our stability and resilience. When the market hits massive volatility, hits massive speed bumps, we don't have to hit those speed bumps with it. If we know that we can see the market is going to recover, we're not going to be jumping out of our positions and trying to get for a lifeboat. We know we're going to be weathering out the storm and waiting until the market calms down. We're going to be doing that. A lot of other portfolio managers jumped out of their positions, not seeing that there was an opportunity for the market to recover perfectly. They decided to take the loss and rather get in later on. Whereas for us, we held through that volatility and we took advantage of the fact that we have the mental resilience to make money while other people are losing it. Now, the other one comes down to the strategies that I make use of. Now, as you're going to see on the YouTube channel, we've got tons of information and educational content that we make use of, that we're giving out to you completely free of charge to help you become better as a trader or investor in the financial markets. Now, further to that, what we do is I run an educational group, and I'm sure you understand that this educational group is quite a big educational group. I train students in over 25 countries around the world via an online training academy. The training programs that we list up are among some of the most advanced training programs in the world. And that's not coming from me, that's coming from people that have gone through my training programs and have been able to see what we deliver to our students. So what I want to do for you is also say to you, if you are interested in taking your performance to the next level, if you're interested in actually finding out exactly how you're able to produce these returns for as long as you're in the financial markets, make sure to jump over to our website and have a look at everything to do with what we offer in our training academy. We offer among the most affordable prices in the entire industry. We offer full 12-month private coaching programs with our team. And most importantly, we are able to provide access to people all around the world. Not only are you able to study online and learn over any online platform available to you, so any website you have, Internet Explorer, Google Chrome, Mozilla Firefox, you are able to access our platforms. Most importantly, if you have a smartphone or a tablet, we have mobile apps specially designed for you to train on the go. So you have full access to study with us at any point in time during your day. These are extensive training programs. And if you're interested in these programs, we're going to put you in the academy and you're going to become a student of ours that we can turn into a success. Because most importantly, behind this report, what we do is what we teach. So our investment group's strategies are the exact same strategies that our educational group studies as well. We don't try and eat steak but teach burger. We eat steak and teach steak at the exact same time. So to any of you who are interested, make sure to follow the links to our website and you can also have a look. But to any of you who are interested in keeping up to date with our channel and with everything that we're providing, make sure to subscribe to the link. And at least then you can keep updated with all the educational content that's coming out on a weekly basis. But once again, everyone, thank you so much for tuning into this video. I hope you managed to learn something interesting, but I will make sure to see you in the next video. Cheers for now, everyone.